This book is dedicated to all investors, large and small, who do not adhere to the philosophy. I have already made up my mind. Don't confuse me with facts. Seems like Fisher was calling for open-mindedness from the get-go.
Right for the start.
Yeah, and we even get insights from his son, Kenneth L. Fisher, in the preface, adding another layer of perspective.
It's fascinating how Kenneth reflects on his dad's work and investing approach, It's like getting a glimpse into the mind of a master investor through the eyes of someone who knew him best.
Absolutely.
Yeah.
So let's dive into some of the key takeaways that can help us, I guess, understand how to find those uncommon profits. One of the things that really struck me was Fisher's emphasis on scuttlebutt. This idea of gathering information beyond the numbers.
Yes, scuttlebutt is really about getting the story behind the story, right?
Yeah.
It's about talking to competitors, customers, suppliers, even former employees,
Wow.
You're looking for those subtle clues, those whispers of insight that can give you a real edge.
I can see how that would be valuable.
Mm-hmm.
But it also sounds a bit intimidating.
Yeah.
How do you even go about doing that? I mean, am I supposed to just cold call a company's competitor and ask for their secrets?
Well, it's more about building relationships and asking the right questions.
Okay.
You might start with industry conferences, trade publications, or even just like reaching out to people on LinkedIn.
Right.
Think of it like investigative journalism,
Oh.
but for investors.
Okay, so it's about connecting the dots, piecing together a narrative from different sources.
Exactly.
That makes sense.
Yeah.
But once you've done your detective work, what are you actually looking for in a company?
Fisher gives us a framework of 15 points to consider
Okay,
when evaluating a company's potential for long-term growth and profitability.
15 points.
Yeah.
That's quite a list.
It is.
Are they all equally important, or are there some that stand out as particularly crucial?
Well, all 15 points contribute to the overall picture, right?
Yeah.
Some might resonate more strongly depending on the specific company and industry.
Okay.
For instance, let's consider the point about outstanding labor and personnel relations.
Okay.
In today's competitive landscape where talent is a key differentiator,
Right.
this point is especially relevant.
It makes me think of companies like Google, known for their employee-centric culture, and how that seems to translate into innovation and success.
That's precisely what Fisher was getting at.
Yeah.
He was ahead of his time in recognizing the link between employee satisfaction and long-term value creation. It's not just about perks, though. It's about fostering a culture where people feel valued, respected, and empowered to contribute their best work.
That makes a lot of sense.
Yeah.
Okay, let's pick another point that intrigues you.
Okay.
What else stands out from the 15?
How about this one? Does the company have products or processes with a strong sales appeal?
Okay.
Fisher wasn't just looking at current sales figures.
Right.
He wanted to understand the underlying demand, the real staying power of a company's offerings.
So it's about looking beyond the hype
Yeah.
and figuring out if there's genuine lasting value in what the company is selling.
Right.
Like that. It's easy to get caught up in the marketing blitz, but this reminds us to dig deeper.
Exactly. You need to discern whether a product is a fad
Right.
or a true innovation that will stand the test of time.
Now, before we get too deep into the 15 points,
Sure.
I have to ask about management.
Okay.
You can have the best product in the world, but if the leadership is weak,
Right.
the company's not going anywhere.
Right. You're absolutely right. Fisher dedicated an entire chapter to the importance of a strong management team. For him, it was a make-or-break factor.
So what qualities did he look for in a management team?
Oh.
Was it all about experience and track record, or were there other factors at play?
While experience and competence are important,
Yeah.
Fisher placed a huge emphasis on integrity.
Okay.
Remember that line from the book?
Remind me.
Does the company have a management of unquestionable integrity?
Right.
He believed ethical leadership was non-negotiable.
It's like you're handing over your hard-earned money to these people, you know?
Yeah.
You want to be sure they're going to use it wisely and ethically.
Exactly. Fisher saw integrity as the bedrock of a successful and sustainable business.
This all makes sense, but assessing management from the outside can be tough.
It can be.
Did Fisher offer any practical advice on how to evaluate a company's leadership?
He suggested applying the scuttlebutt method here as well.
Yeah, interesting.
Talk to employees, former employees if possible, industry analysts, anyone who might have insights into the company's culture and leadership style.
Okay.
Read company communications, earnings calls, transcripts, anything that might give you clues about how the management team thinks and operates.
So it's about piecing together the puzzle, looking for patterns and consistencies in the way the company is run,
Yeah.
and how decisions are made.
Precisely. It's like being a detective.
Right.
But instead of solving a crime,
Yeah.
you're trying to assess the long-term viability and trustworthiness of a company.
Okay, so we've talked about scuttlebutt
Right.
and the importance of strong management.
Mm.
What other gems did Fisher offer in common stocks and uncommon profits?
He provides a lot of valuable advice,
Okay.
including guidance on when to sell a stock, which can be just as challenging as deciding when to buy.
I was just thinking about that.
Yeah.
It's so easy to get emotionally attached to a stock and hold on for too long, or panic and sell at the first sign of trouble.
Mm-hmm.
What was Fisher's approach?
He was a firm believer in long-term investing,
Oh.
holding on to stocks as long as the underlying company continued to meet his criteria.
Right.
But he also acknowledged that there are valid reasons to sell.
Okay, so when did Fisher actually recommend selling a stock?
He outlined 3 primary reasons.
Okay.
If you realize you've made a mistake in the original purchase,
Mm-hmm.
if the company deteriorates in some significant way,
Right.
or if you find something even more attractive.
Those reasons make sense.
Yeah.
But I imagine it can still be tough to pull the trigger, especially if a stock has been performing well.
Mm-hmm.
Did Fisher have any advice on how to overcome that emotional hurdle?
He stressed the importance of having a clear investment philosophy, a
And
set of rules or principles that guide your decisions.
so it's about having that inner compass, that
Exactly.
clear sense of what you're looking for and why,
Uh-huh.
so you don't get swept away by market noise or short-term fluctuations.
It's about having conviction in your investment thesis and the discipline to stick to your plan, even when the market is testing your patience.
That reminds me of something else Fisher talked about, the importance of not following the crowd.
Yes.
He seemed to be a big believer in independent thinking.
Absolutely. He warned against blindly following the herd, especially when it comes to investment decisions.
Okay.
He encouraged investors to do their own research, form their own conclusions,
Right.
and be willing to go against popular opinion.
So it's about being your own investing guru,
Yeah.
trusting your own judgment, even when everyone else seems to be heading in a different direction.
Precisely. It's about having the courage to think differently, to challenge conventional wisdom, and to trust your own analysis.
It sounds like Fisher's philosophy is as much about developing a certain mindset as it is about specific investment strategies.
You're absolutely right. It's about cultivating a mindset of curiosity, discipline, and long-term thinking.
And a healthy dose of skepticism, perhaps.
Oh,
After all, Fisher warned us about those promotional companies that rely more on hype than substance.
you've got it. You wanted investors to see through the smoke and mirrors and focus on the true drivers of long-term value creation.
Okay, so we've covered a lot of ground.
Yeah.
From the power of scuttlebutt to the importance of ethical management and the perils of following the crowd.
We have.
Before we wrap up part 1 of our deep dive, I want to ask about another key concept Fisher explored: dividends.
Okay.
How did he view those steady payouts that many investors crave?
You're in for another unconventional perspective. Fisher wasn't a big fan of constantly increasing dividends.
Really?
Yeah,
That's surprising.
it is.
Why would a company choose to hold back earnings instead of sharing them with investors through dividends?
Fisher argued that for companies with strong growth potential,
Right.
it's often more beneficial to reinvest those earnings back into the business.
Okay.
This could involve funding research and development, expanding into new markets, or making strategic acquisitions.
So it's about prioritizing future growth over immediate payouts.
Mm-hmm.
But wouldn't investors be missing out on those regular income streams?
Fisher believed that, in the long run,
Yeah.
investors would benefit more from a company's increased earnings and the resulting stock price appreciation than from a few extra dollars in dividend payments.
So it's about playing the long game, trusting that those reinvested earnings will ultimately lead to a greater return on investment.
Exactly.
But did Fisher think all companies should follow this approach?
He acknowledged that there are situations where dividends make sense,
Okay.
particularly for mature companies with limited growth opportunities.
Got it.
However, for those companies with significant growth potential,
Yeah.
he believed reinvesting earnings was usually the more strategic move.
It's about aligning a company's dividend policy with its overall growth strategy, making sure they're working in tandem rather than at odds.
Exactly. Fisher wasn't saying dividends are bad.
Okay.
He just believed they shouldn't come at the expense of long-term growth.
It's about finding that sweet spot, that balance between rewarding investors today and building a brighter future for tomorrow.
Well said. And that brings us to the end of part 1 of our deep dive.
Okay.
We've explored some of the key takeaways from common stocks and uncommon profits.
Yeah.
From the power of scuttlebutt to the importance of ethical management and the nuances of dividends.
Great.
Stay tuned for part 2, where we'll delve even deeper into Fisher's insights and uncover even more gems from this investment classic.
Looking forward to it.
Yeah. Welcome back to our deep dive into common stocks and uncommon profits.
Thanks.
You know, I'm still thinking about how Fisher viewed dividends.
Yeah.
That's a perspective you don't hear every day, you know?
Right.
It really challenges you to consider the bigger picture of how companies allocate capital.
It definitely got me thinking.
Yeah.
It's easy to get caught up in those quarterly payouts.
Sure.
But Fisher's argument for reinvestment really resonated with me. It makes you wonder how many companies might be sacrificing long-term growth.
It's just for the sake of keeping those dividend checks flowing.
It's a delicate balance for sure, yeah.
Yeah.
And it highlights the importance of understanding a company's overall strategy and how dividends fit into that picture.
Speaking of strategy,
Yeah.
one thing that stood out to me in the book was Fisher's emphasis on a company's ability to innovate.
Okay.
He wasn't just looking for businesses that were currently profitable, really.
Right.
He wanted to see evidence of continuous innovation, a pipeline of new products and services that could drive future growth.
That's a crucial point.
Yeah.
Fisher recognized that in a dynamic market, standing still is essentially moving backward.
Right.
Companies that fail to adapt and evolve are doomed to be overtaken by competitors.
He used the term growth companies, but it wasn't just about growth for its own sake.
Right.
It was about sustainable growth, fueled by a company's ability to anticipate and respond to changing customer needs and market trends. Exactly. He wasn't impressed by companies that were simply growing through acquisitions or cost-cutting.
Right.
He wanted to see evidence of organic growth, driven by a genuine understanding of the market and a commitment to bringing new and innovative products to the world.
So how do you actually assess a company's ability to innovate?
Well,
It's not like you could look at a balance sheet and see a line item for innovation potential.
that's where the detective work comes in, right?
Okay.
You need to dig deeper, look beyond the numbers, and really try to understand the company's culture, its leadership, and its overall approach to research and development.
So it's back to the scuttlebutt method.
Yeah.
Talking to people, reading industry reports, piecing together a narrative of how the company operates and where it's headed.
Precisely.
Okay.
You want to look for companies that are investing heavily in R&D, that have a track record of bringing successful new products to market,
Right.
and that are operating in industries with long-term growth potential.
It's about identifying those companies that are not just riding the current wave, but are actively shaping the future, creating the next wave.
Exactly. And it's important to remember that innovation isn't always about groundbreaking inventions.
Right.
Sometimes it's about incremental improvements,
Yeah.
refining existing products or processes to make them better, faster, or more efficient.
It's about that constant striving for improvement,
Yeah.
that relentless pursuit of excellence that sets truly innovative companies apart.
Well said. And this ties back to Fisher's emphasis on long-term thinking. He believed that truly great companies are built to last.
Sure.
They're able to adapt and evolve over time, and they're constantly seeking new ways to create value for their customers and shareholders.
It makes me think about those companies that have been around for decades, even centuries, constantly reinventing themselves to stay relevant and competitive.
Right.
They're like living proof that Fisher's principles are timeless.
Absolutely. And this focus on longevity also informs Fisher's perspective on when to sell a stock. Right. He wasn't advocating for day trading or short-term speculation.
Okay.
He believed in holding on to investments for the long haul, as long as the underlying company continued to meet his criteria.
We talked about his 3 reasons for selling earlier,
Right.
but it's worth emphasizing that he didn't encourage selling just because the market was jittery or a stock had a temporary dip.
Exactly.
He was all about looking at the big picture, focusing on the fundamentals, and having the patience to let those long-term trends play out.
Exactly. He believed that too many investors get caught up in the short-term noise of the market, reacting emotionally to every little fluctuation.
Right.
He wanted investors to stay focused on the underlying value of their holdings.
Okay.
And avoid making impulsive decisions based on fear or greed.
It sounds like a lot of Fisher's philosophy is about developing a certain mental discipline, a way of thinking that helps you stay grounded amidst the chaos of the market.
Absolutely. He believed that successful investing wasn't just about picking the right stocks.
Yeah.
It was about cultivating the right mindset.
Okay.
A mindset that embraces long-term thinking, independent judgment, and a willingness to learn and adapt.
It's about being a student of the market, constantly seeking new knowledge, refining your approach, and challenging your own assumptions.
Well said. And that brings us to another key concept from the book.
Okay.
The importance of not overstressing diversification.
Oh, interesting.
This might seem counterintuitive.
Yeah, it does.
Especially since we're often told to spread our investments across different asset classes to manage risk, right?
Right.
But Fisher had a different perspective.
He actually cautioned against excessive diversification,
Yes.
arguing that it could dilute your returns and prevent you from fully capitalizing on those truly exceptional companies.
Exactly. He believed that by spreading yourself too thin,
Right.
you might miss out on those big winners, those companies that could generate truly uncommon profits. He advocated for concentrating your investments in a smaller number of companies that you truly understood and believed in.
So it's about quality over quantity,
Yeah.
about doing your research, finding those hidden gems, and then having the conviction to invest meaningfully in those companies.
Precisely. And this ties back to his emphasis on independent thinking and doing your own homework. Don't just blindly follow the crowd or invest in what everyone else is talking about.
Right.
Find those companies that you believe in, that you're excited about, that you think have a potential to change the world.
Instead, find those companies that you believe in, that you're excited about, that you think have the potential to change the world.
Exactly. Investing should be an intellectually stimulating and personally rewarding endeavor, you know?
Yeah.
It's not just about making money. It's about participating in the growth and innovation that are shaping our future.
It's about being a part of something bigger than yourself, supporting those companies that are making a difference and creating a better world.
Well said. And that brings us to the end of part 2 of our deep dive.
Okay.
We've explored some of the key takeaways from common stocks and uncommon profits.
Right.
From the importance of innovation and long-term thinking, to the power of concentrated investing and the perils of following the crowd.
Right.
Stay tuned for part 3,
Okay.
where we'll wrap up our exploration of Fisher's timeless wisdom
Awesome.
and consider how his insights can guide us on our own investment journeys.
Welcome back to the final part of our deep dive into common stocks and uncommon profits.
Okay.
You know, as we've been talking about Fisher's philosophy,
Yeah.
I've realized it's like more than just a set of investing tips.
Right.
It's a whole approach to thinking about business and the world.
I agree. Fisher was a true visionary. And his insights are just as relevant today as they were decades ago.
Yeah.
He had a remarkable ability to see the long-term trends
Right.
and identify those companies that were poised to capitalize on those trends.
One thing that keeps coming back to me is his emphasis on the human element of investing.
Oh, interesting.
It's not just about analyzing spreadsheets and crunching numbers, right?
Right.
It's about understanding the people who are running the businesses,
Yeah.
the people who are creating the products,
Mm-hmm.
and the people who are ultimately buying those products.
Absolutely. Fisher recognized that businesses are ultimately driven by people.
Yeah.
Their vision, their passion, their execution, that's what makes or breaks a company.
Right.
He wanted investors to look beyond the financials and really try to understand the culture, the leadership, and the overall values of the companies they were considering.
It's like that saying, invest in people, not just ideas.
Yeah.
Fisher seemed to understand that a brilliant idea won't go very far without the right people to bring it to life.
Exactly. And that's why he placed so much emphasis on finding companies with strong management teams. Leaders who were not only competent, but also ethical, visionary, and capable of inspiring and motivating their employees.
We talked earlier about his scuttlebutt method.
Right.
And how it can be applied to evaluating management.
Yeah.
It's really about getting a feel for the company's culture, seeing if there's a good fit between the leadership and the employees,
Right.
and understanding how decisions are made.
It's like peeling back the layers of an onion, getting to the heart of what makes the company tick.
Right.
And it's not always easy to do from the outside.
I imagine not.
But with some careful research and a bit of detective work, it's certainly possible to get a sense of the company's internal dynamics.
And, you know, as we're talking about this, it makes me realize that Fisher's philosophy is all about taking ownership of your investment decisions.
Oh, okay.
It's not about blindly following the crowd or relying on someone else's recommendations.
Right.
It's about doing your own homework,
Yeah.
forming your own conclusions,
Yeah.
and being accountable for your own choices.
Absolutely. Fisher was a champion for independent thinking, and he encouraged investors to trust their own judgment even when it went against conventional wisdom.
He really challenged investors to be active participants in the process, to engage with the companies they were investing in,
Right.
and to think critically about every decision.
That's so true.
Yeah.
It's about being an engaged investor, not just a passive bystander.
Right.
It's about understanding the businesses you're investing in, following their progress, and being prepared to adjust your strategy as needed.
And it's about being patient.
Right. Oh, definitely.
Fisher wasn't interested in get-rich-quick schemes or chasing the latest fads.
Yeah.
He believed in the power of long-term investing, letting those compounded returns work their magic over time.
Exactly. He understood that building wealth is a marathon, not a sprint. It requires discipline, perseverance, and a willingness to ride out the inevitable market ups and downs.
And speaking of those ups and downs,
Uh-huh.
Fisher had a lot to say about dealing with the emotional side of investing. He recognized that fear and greed can cloud our judgment
Yeah.
and lead to costly mistakes.
He emphasized the importance of having a clear investment philosophy,
Right.
a set of principles that could guide your decisions and help you stay grounded amidst the market's turbulence.
It's like having that inner compass, that unwavering belief in your strategy, even when the market is sending mixed signals.
It's about separating logic from emotion, making rational decisions based on your research and analysis, rather than reacting impulsively to short-term market noise.
And it's about recognizing that mistakes are inevitable.
Definitely.
Even the best investors make bad calls sometimes.
It happens.
What mattered to Fisher was learning from those mistakes and refining your approach over time.
Absolutely. It's about embracing a mindset of continuous learning, always seeking new knowledge, challenging your assumptions, and striving to improve your skills.
Well said.
Uh-huh.
And that brings us to the end of our deep dive into common stocks and uncommon profits.
Wow, time flies.
We've covered a lot of ground today,
We have.
exploring Fisher's insights on everything from the importance of innovation and strong management to the power of scuttlebutt and the perils of following the crowd.
It's been a fascinating journey through the mind of a true investing legend.
Yeah.
And I hope our listeners have gleaned some valuable insights
Me too.
that they can apply to their own investment journeys.
As we wrap up, I want to leave our listeners with this thought.
Okay.
Fisher's book isn't just a guide to picking stocks.
Right.
It's a framework for thinking about business, about innovation, about leadership,
Yeah.
and about the human element that drives it all.
It's a timeless classic that encourages us to think differently, to challenge conventional wisdom, and to embrace a lifelong journey of learning and growth.
And most importantly,
Yeah.
it reminds us that investing is more than just a way to make money.
Absolutely.
It's a way to participate in the progress of humankind, to support those companies that are shaping the future, and to be a part of something bigger than ourselves.
Beautifully said.
Yeah.
So, to our listeners, we encourage you to pick up a copy of Common Stocks and Uncommon Profits.
It's a good one.
Delve into Fisher's wisdom, explore his ideas, and see how his principles can guide you on your own path to uncommon success.
Thanks for joining us on this deep dive.
It was fun.
Until next time, happy investing.